So let's start with the structured dividend capture because that naturally has created a lot of questions. Super interesting. So first of all, about timing. One big question from several people is that posting the plan for option buying for the next 3 months possibly lets others manipulate those prices, and option markets don't have a lot of liquidity. How does this work? Are options mispriced? Does the market not drop enough by the amount of dividends? Why aren't other people doing this in a larger amount to the point where this would no longer work?
It's a very good question. And we thought for a long time about whether or not we wanted to provide this information to all of you. I want to provide it to all of you, but we also want to keep being able to execute on this. The fact is that these products are used by everyone else for a different reason. And everyone is not going to just come over to our side. In fact, I've been telling and explaining structured dividend capture to people for years, and it has had no impact on the price of these contracts because there are so many people on the other side. And I just, frankly, people aren't really equipped to start doing this in a major way. There are many securities out there, and other people might look at different stocks that they prefer. But this could also, I am fairly confident that this is actually going to stick around. If all of these, by the way, if all of these premiums shrunk to a level that we found was no longer attractive, what that would mean is that the options were actually quite cheap. And so suddenly, while everyone's selling calls, we would actually be buying them. We wouldn't just keep selling calls blindly if the prices shrunk because everybody tries to capture dividends. We would recognize that we could take the opposite side and buy a call for a very cheap price because everybody's pushed it down. We will see how this plays out, but we are pretty far ahead of everyone else. And I think this is going to stick around for a while.
Specifically, do you wait until the companies have announced their dividend?
Oh, yes, we of course. So what it is there's an ex-dividend date and there's a date of record. So that we know that the dividend is coming. We know exactly how much is coming. You know, you can go out and look a few months and see what dividends are on the horizon. So we simply write a put, and we write a put maybe a week prior, and it expires as close to that date as possible, sometimes the day before. And then as soon as we receive the dividend, we just exit with a call. And so we can hold these shares for a very small amount of time and capture these 3 payments. But we absolutely know that the dividend is coming. And in many cases, the dividend is quite large. And of course, the premiums are also quite large. It's a good question.
So I think the obvious next question is about taxes. These are short-term gains. Mm-hmm. How does that affect the portfolio and the fund?
So none of this affects the portfolio much at all. And I know this is a very interesting, it's exciting for us too, and we're going to make a lot of money with this, but this is just a cash alternative for some capital. Basically, the cash is sitting idle, and we have an opportunity to pull some dividends out of the market over these brief periods of time. Now, it's all treated as short-term capital gains. That's how this works. And so if we make 37%, as shown here on this slide, you know, it will be at your marginal tax rate. That will be the tax rate for those. But we're not going to just leave. We found this opportunity. Just because we pay tax doesn't mean we're not going to do it. If there's $100 sitting on the ground, we're going to pick it up, even if we have to split it 50-50 with the government. So that is what we're doing. It is an unfortunate. I don't like paying tax. And I think the reason that this question is so important is because our long-term compounders, we don't have to pay tax. We're not realizing the gains. They're all unrealized gains. And so, so those continue to just compound. But yes, as we pick up these premiums and dividends, they are taxable. And then those flow through your your K1s. And to put it in perspective, if we have 20% of our portfolio running through this, and we even make, I don't want to overestimate, but we might make a lot. So if we make a 20% return, or I think the back testing showed 15, but there are some conservative assumptions. You know, if we put 20% of our portfolio in, we now have like 3%, which is going to appear as short-term capital gains. So maybe take your balance and think, okay, so like a 1% of that balance might be my tax payment, 1.5%. It's not going to be significant. And if it is significant, just redeem a little capital to pay your taxes, and you'll still have more than you started with. So we have to pay taxes, unfortunately, but it's still worth pursuing.
Just to follow up on that point,
Yeah.
we got a specific question about Icon because Icon has a K1. Does that flow through to the partners in the fund, or is it
No.
handled by? Okay.
No, it is just like owning. It is just like owning Berkshire Hathaway. It's just a corporation. It's nothing that flows through.
And then how many positions each month is the fund getting into in this strategy? Is it diversified? Is it,
Yeah.
Typical diversification, many, 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 or is it just a few?
So we have to be very selective with our positions, but the way that this process works now is we're analyzing for our own 13F analysis. We're analyzing about 113Fs each quarter, and then that narrows it down to about 400 or 500 companies that are owned by these great firms. We then look at all of those and start removing the ones that have problems. And of course, they need to have dividends, and of course, they need to have options. And that leaves us on a quarterly basis with about 30 to 40 that are of interest to us. And we then have this Gantt chart. It's now an automated process where we receive our Gantt chart, and it lines up all of the capital flows according to the ex-dividend dates and the option expiration times. And so what I think is a reason, and of course, some months will have more and some months will have less. And it's important to note here, I'll point out that it maintains all of our liquidity. These are constantly expiring, and we're just back to a ton of cash. So, if we have to run through 30 of these in a quarter, there might be 10 a month. And maybe that's really broken up into a few weeks. So on the weekend, we will look through things, and we understand well in advance where the capital needs to go. And it's sort of like we'll own five or so at any one time. And then this basket of those, call it a half dozen securities, we call that one security, and we have, of course, the rest of our portfolio as well.
So a question just came in the chat just as you were saying that, asking about whether or not you consider extrinsic values in the companies that you choose for this structured value strategy.
Yeah.
And it sounds like you do.
Yes, we are absolutely very carefully considering that. We don't need to hold the greatest companies in the world. Okay, let me be clear. It's not like we need to restrict ourselves to something that's going to compound 100x over the next 20 years. All we need is a company that's going to be reliably paying their dividend, and hopefully there isn't a major problem. We are holding these companies for a relatively short period of time. And in those 5 or 10 days, it is unlikely for the movement to happen. And again, it was difficult for us to be confident, although we were recognizing through all our analysis which work. It wasn't until we were able to get our back testing completed to recognize that this is truly effective. In fact, as I mentioned, we have 100 quarters of data. Out of those 140 quarters of data, there are only 4 quarters that show a decline. And then, of course, following a decline, there's often a rise. So within a quarter, we've come back. And so it's pretty amazing.
And the question was asking about, I'm glad that you talked about that, but the question was asking about whether or not the premiums are deep in the money.
Oh, I'm sorry. So are the premiums deep in the money? So what we are doing is it's the strike price and the price of the stock. So we will write the, I'll help you guys out here, but honestly, I probably
Can I rephrase the question?
Sure.
Sorry, so I can rephrase the question. So just when you're entering and exiting these pre-planned companies, and thank you very much, Matt, for presenting this. This is amazing. I was here last year. I tried to replicate it. I was successful on 2 businesses, and then the third one I lost a little bit much, and then I couldn't find a group to continue. But back to the question, are you looking at extrinsic premiums, the time value premiums, or are you just going in the money just to make sure that you do get assigned? And that's my question. Sorry.
Great. It's a great question. We're actually very conservative with this. And so typically we'll be writing a strike that is just below, we'll put the strike just below the current market price. So it will be out of the money. So we pick up, and by the way, you're asking a very good question. But what we are doing is more complicated. That's the problem. We have shown this as a very simplified example, but really we have a matrix. So we're actually doing both. We're writing in and out of the money, and we're usually capturing some and not all of the position. But typically, I think you should think about it like, you write a slightly out of the money put, and if you don't get the shares, you just got the premium, you still have your cash, you just move to the next one, the next quarter. If you do get the stock, then you get the dividend, and then you exit with the call and you're out and you move to the next stock. So I think selling a single put slightly out of the money, you'll do quite well. And in fact, I think Sid can confirm that he's not executing this on his own.
Yeah. So what Matt's saying is absolutely correct. So I think so even in the back testing, we've had very conservative numbers, right? So once we can get, so Matt, can you help clarify
So
the point I'm trying to make?
I'll elaborate. I know where Sid's trying to go, and then we'll jump back into the questions. There are quite a few problems when you try to back test a global set of option data over into the 90s. There's just missing data everywhere. In fact, the reason we only went back 7 years in this test, so it looks so small and I didn't think, it's because we have so many biases. We have survivorship bias. The 13 Fs that we're looking at today didn't exist 12 years ago. And so we really can't test back very far without going through a whole new set of different firms that we may have been following at that time. So the data integrity is a challenge for us. And in fact, the biggest challenge is just missing data. So one solution we were considering is we could just derive them using the Black-Scholes model, but the computational power, I mean, it would just be absolutely nightmare. And then the Black-Scholes wouldn't necessarily be the true market price. So that doesn't really work. So if we're missing data, we basically need to just cap these returns. And we want to be so conservative that we just cap, if we can't find a reliable put figure in 2002 for some security we're trying to buy, we will cap the put premium at 1%. And you can see here, it's totally unrealistic. We wouldn't ever sell a put and just get a 1% premium. So all those sort of numbers are in our data, and it's still providing 15% annualized returns, even when we're using really conservative data when there's missing figures. Thanks, Sid, for bringing that up.